Okay, so taking you through Afghan Sun Chapter 3, which is the finance chapter. The main sections from this chapter are 3.1 Sources of Finance, found on page 219, 2.2 Costs and Revenues, and in this question I'm going to focus on revenue expenditure and capital expenditure, which you'll find on page 220. 3.3 Break-Even Analysis, which you'll find on page 238. All of these page numbers refer to the Pull Hwang textbook. 3.4 Final Accounts, which in this case is the profit and loss account and the balance sheet, found on page 252 of the textbook, and 3.7 Cash Flow Forecasts, page 291 of the textbook. Now these are the most likely elements of the finance to come up. However, of course, depending upon the additional materials you receive during the exam, you could also be asked to do investment appraisals, that's the average rate of return or the payback period, or ratio analysis as well. So it's worth having a look over those sections of the chapter as well. So let's start with section 3.1, which is Sources of Finance. And I'm referring to line 63 of the case study, which states Sue has already decided that most of the finance for the production facilities would come from share capital provided by herself and loans from HH. She wondered whether other stakeholders from HH, both internal and external, might want to support the project through some sort of financial assistance. The question is to discuss the advantages and disadvantages of Sue's decision of sources of finance for the production facilities. Pause and have a go, and then have a look at the solution answer. Okay, so hopefully you've had a go at that particular question. Let's have a look at some model answer for this. Both share capital and loan capital, the two sources of finance, are examples of external sources of finance. Although in this case, as the share capital is coming entirely from Sue's purchase of shares in the company and the loan capital is coming from Sue's other business, she is maintaining a certain level of control over both sources. Issuing shares can generate a significant amount of money, which does not need to be repaid. Currently, Sue is planning on purchasing $200,000 worth of shares in AS. The disadvantage of issuing shares is the possible loss of control, as decision-making will be shared by the key shareholders. But at the moment, Sue is not stating that she will be inviting friends and family to buy shares in AS, although she does mention that she thinks other stakeholders of HH might be interested in supporting the project financially. This could possibly be through the sale of shares. Loan capital is a slightly higher risk source of finance as it needs to be repaid with interest. Sue is not taking a loan from a bank, but rather is borrowing $50,000 from her other company, HH. So we might assume that the interest would be lower because Sue is in control of that. We don't know the type of business that HH is. If it's a publicly limited company, her HH shareholders might not be happy about the loan to AS, as this could impact their dividends. So this is looking at sources of finance, relevant sources of finance. It considers different stakeholders and their perspectives. It considers some of the advantages and disadvantages. And remember, in a question like this, we haven't actually been given the amount of money required for the production facilities. We're basing this upon the data in the cash flow forecast, which shows capital expenditure of $200,000 and an income of $200,000 from share capital and $50,000 from loan capital. But this may well need to be adjusted in the final exam, depending upon additional materials provided. Let's move on. Question 2.2, Costs and Revenues. And this is showing you the 6-monthly cash flow forecast for Afghan Sun for the first 3 years of operation. So broken down into 6-month windows. And this is where you can see Sue's share capital and the loans from HH as income prior to the sales income. So sales, of course, is sales revenue. Capital expenditure, we're going to have a look at now. Sales costs, this would be the cost of goods sold, okay, or the direct costs, otherwise known as. Other costs is not identified, however, we could assume that these are expenses or overheads, indirect costs essentially, and then closing balance. Again, you've not been provided with the net cash flow for this, so you might be asked to calculate it. Net cash flow is total cash in minus the total cash out. Okay. So in the context of Afghan Sun, distinguish between capital expenditure and revenue expenditure. Have a pause and have a go at that question. Okay, so let's have a look at a model answer for this. What I've done before I've gone into my model answer is I've just identified some keywords that I'm going to try and use in my model answer. So these are some specific definitions. They are a little bit wordy. They're not exactly the textbook ones, but they're just to give you a better idea. It is important that you know your keywords, especially your financial keywords, because they do come up. So fixed costs are costs of production which do not change with the increase or the decrease of output. Examples include rent and salaries. Fixed costs are shown in the break-even chart. It is important to remember that it is not enough to say that fixed costs don't change. They do change, just not in relation to output. So for example, your rent can go up, but it doesn't go up because you produce more products, okay? So fixed costs do change as a result of changes in the external environment, but they are not changing in relation to output. Variable costs are costs of production which do change with the increase or decrease of output. Examples might include raw materials and packaging. Variable costs are shown on the break-even chart. Direct costs are costs specifically related to the production of a particular product or related to an individual project. They are often variable costs, but not always. Sometimes a business incurs a cost, like rent, for a particular machine which is only used for one product. This is a fixed cost as it does not change with output, but it's also direct. So the difference between a direct cost and a variable cost is variable costs all change with output, but direct costs are specifically related to the production of a particular product. They can be both variable or fixed, but they are most often variable. An indirect cost. Again, this could be both variable or fixed, but in this case, they are costs known as overheads or expenses that are not, they're seen in the profit and loss account, and they are not attributed to the production of a particular item or project. In the profit and loss account, we would say gross profit minus expenses equals net profit before interest and tax. Expenses is indirect costs. So indirect costs, otherwise known as overheads or expenses. They're not attributed to the production of a particular item or product, like advertising or rent on a factory which produces more than one product or an electricity bill, for example. So now let's have a reminder of the question that we asked, which was in the context of AS distinguish between capital expenditure and revenue expenditure. Capital expenditure is finance spent on the purchase or maintenance of fixed assets. These items have value and serve a long-term purpose for the business, like buildings and machinery. The business does not intend to sell them in the short term. AS intends to spend $200,000 in capital expenditure in its second half of 2018. As these purchases tend to be large investments requiring significant sums of money, the source of finance tends to be medium or long term. In the case of AS, share and loan capital. Revenue expenditure refers to the payments made in the daily running of the business, like wages, raw materials, rent and electricity. These costs are both variable, changing with output, and fixed, do not change with output. They are also both direct, specifically related to the production of a particular product, or indirect, like insurances, advertising, which is used for several different products. These are the day-to-day costs associated with the business, and they do not purchase an item that holds value and remains in the business, like capital expenditure. Another way of remembering it is that capital expenditure is shown in the balance sheet, whereas revenue expenditure is shown in the profit and loss account. Moving on. A break-even analysis question. The sample additional material I'm providing is not taken from the case study. Please be aware of this. Do not memorise this. It is useless to you because it is made up. You will, however, be given additional material in the case study, and the likelihood is some of it will be financial, so you may have to do something similar to this. This is a good practice, however, for the basic calculations you would have to produce. So, the additional material I'm providing you with. David has decided upon a selling price per unit of $90. He hopes to sell 300 units per month. Salima has estimated the cost of productions for the solar power systems. Raw materials will cost $45 per unit plus packaging of $2. Monthly rent on the factory will be $2,500. Electricity and utility bills cost $260 per month. A basic piece rate pay system for each unit completed will add $10 to the basic salaries for the workers. The total expected basic salaries is estimated at $54,000 per year. So you have some information per month and some per year. It's important to be aware of because I'm now being asked to calculate the monthly break-even point and the monthly margin of safety, but then to calculate the estimated yearly profit. So some things will have to be divided by 12 to find the monthly value, and some things will have to be times by 12 to find the yearly value. Let's start with the break-even point. I'd like you to pause, take a piece of paper, and figure out your monthly break-even point with this information. Okay, so hopefully you've paused and you've done the calculations yourself. Let's have a look. So, calculating the monthly break-even point. First of all, I want to find my monthly fixed costs. So the monthly fixed costs would take the yearly salary of 54,000 and divide it by 12 to find the monthly, which is 4,500, plus 260 plus 2,500 would give me 7,260 in monthly fixed costs. The average variable costs was 45 for raw materials, plus 2 for packaging, plus 10 for piece rate pay. So that's $57 per unit. The contribution is the price minus the average variable cost. The price was 90 minus 57 equals 33. Break even is the fixed costs divided by the contribution. So that is 7,260 divided by 33 gives me a break even point of 220. So the next task you were asked for was the margin of safety. The margin of safety is the difference between the break even point and the expected capacity or maximum output. This shows us how many the business can afford not to sell, for example in a bad month, before falling below break-even and therefore making a loss. So very simple, expected output or capacity minus break-even shows me the difference. The margin of safety in this case is 80 units because Afghan Sun intend to sell 300 per month. They make break-even at 220 per month. So they have a margin of safety of 80 units. They could afford not to sell 80 units in a bad month before they made a loss. And the last one, which is the profit. So calculating the estimated profit. Now I know profit is sales revenue minus total costs. Sales revenue is quantity times price, and the total costs are the fixed costs plus the average variable cost times quantity. So first of all, I've identified my yearly fixed costs. Okay, so some things I have to multiply up by 12. The salaries were already as a yearly figure, 54,000, plus the utilities and electricity multiplied up by 12, which was 3,120, plus the rent multiplied by 12, which was 30,000. So that gives me a fixed yearly cost of 87,120. The variable costs, which we had at $57, need to be multiplied by output times 12, because output was 300 expected per month. There are 12 months in a year, so that is 3,600. 57 multiplied by 3,600 is 205,200. So total costs are 87,120 plus 205,200 gives me 292,320. Then with the sales revenue, the price of 90 multiplied by the maximum output, which was again 300 times 12. Okay, so 3,600 times 90 gives me 324,000 as sales revenue. So the profit is 324,000 minus 292,320, giving me an annual profit of 31,680. Okay, moving on. Final accounts. In the context of Afghan Sun, describe the purpose of the final accounts to at least two different stakeholders. So why do two different stakeholders want to see Afghan Sun's final accounts? Pause and have a go, and then come back and have a look at the model answer. Okay, so the final accounts are the profit and loss account and the balance sheet. The profit and loss account shows the trading position of the business at the end of a trading period. This shows the distribution of sales revenue as it is spent on revenue expenditure. The balance sheet shows the assets and liabilities of a business at a particular period of time. This balances what a company owns with what a company owes. Internal stakeholders at Afghan Sun will use the financial accounts to manage the business and aid strategic decision making. For example, Sue will monitor the final accounts of the business over the first years to ensure that her expenses are under control and that the business is in a good liquidity position. External stakeholders, like the Afghan government or AK Bank, who are partners of AS, would be interested in the final accounts, as this will enable the government to identify the amount of tax to be paid by the company. This will also enable AK Bank to monitor the success of the project and decide upon their continued participation. So remember, any stakeholders, internal or external, I could talk about customers, I could talk about competitors, I could talk about employees, managers, potential future shareholders, all different groups of stakeholders, and thinking about why they would be interested in the final accounts. Moving on, cash flow forecast. In the context of AS, identify 2 possible causes of cash flow problems and suitable strategies to deal with them. You are provided with the cash flow forecast in table 2 of the case study. Have a go and pause the video and come back to see and compare your answer with the sample answer. For Afghan Sun, one possible cause of cash flow problems would be overstocking. If the business produces too many solar power systems without customers to purchase them, they would have liquidity problems. Overstocking means the increase in costs for storage and insurance on those items, and an increased risk that the items will become obsolete. While money is invested in the production of stock, if that stock is not quickly sold, the business will not have the cash inflows to support the production of more stock. Another possible cause of cash flow problems for AS would be unforeseen changes in the external environment. Political instability, changes in the exchange rate, and the risk of terrorist attack could all cause problems for AS in production, management of goods, and distribution, leading to cash flow problems. The main strategies for dealing with cash flow problems is to reduce outflows, increase inflows, sorry, that should say inflows, there's a typing error there, or seek alternative sources of finance. In the short term, if AS is anticipating a negative cash flow in the coming months, it will be sensible for them to arrange an overdraft with the bank. The interest rates are high, but this will enable the business to continue to pay its short-term debts and maintain a positive relationship with their suppliers. So I'm identifying here an alternative source of finance as a solution to cash flow problems, but you could also identify methods of reducing outflows, like reducing expenses or finding cheaper raw materials, or to increase inflows, like better promotion methods to increase sales, or finding additional sales revenues, additional sources through things like government grants or subsidies. So that concludes our Chapter 3 tutorial, and the next video to be posted will be Chapter 4.